Folks, this is Chuck Evans and David Tinsley. We're going to start in a few minutes. Wait for some people to sign on. Thank you. I see Stephen Hayes there. Stephen Hayes,
Hey, Chuck, how's it going?
doing
Hello,
well. How are
sir.
you?
Doing well.
Do you have the PowerPoint loaded on your laptop?
I do.
Awesome. We'll let you change the screens.
Okay.
We'll get started in a second. We're waiting for some more people to sign on. How's things in Wilmington, North Carolina?
Good. It's been hot. Very
Been
hot.
hot. Yes, I've heard. And Birmingham, Alabama, hot.
You
Yeah.
can count on it.
So, Chuck, what's the order? Are you just going to kick it off to me and then ask
It's
questions?
live already, Steve.
Okay, cool.
So yeah, basically what we do here is talk a little bit about why we have this on a monthly basis, and then we bring in guests every month, and you're our guest this month.
Awesome. Like,
Yeah,
super excited.
that's awesome. See, Sam Rent is on the phone, on the line. That's good. Tammy Dillard. David, what do you think? Should we get started? I think so.
Yeah, I
We're going
think
to
we
go
could
ahead and
probably
get
go ahead.
started, folks. Chuck Evans here with 30 at noon with Lenders Cooperative. The purpose of these monthly webinars is not to replace the the techniques and the classes from NAGL or NADCO, but to bring you industry stakeholders every month that can share best practices, whatever their specialty is. And so that's what we have today. Before we get started with our guest, David Tinsley is going to manage the chat box, and we're going to have a lot of information to cover. So if you don't cannot stay on for whatever reason, we're going to send you this PowerPoint after the webinar. Before we get started, I know Brad, our marketing person, wants at least a Lenders Cooperative commercial. So David, can you provide us that?
Absolutely. So Lenders Cooperative. So it's an organization that we specialize with a loan origination, and servicing system platform. It's all integrated, and we also have shared services that includes things like credit underwriting, SBA lending as an LSP, bank operations, call center, kind of you name it. We're your partner in getting commercial lending accomplished, all while being compliance with all the regs, and then just really looking for ways to help you streamline and reach your customers.
Well, thank you. So today, Stephen Hayes is our guest. He works for Lenders Cooperative. Stephen started his banking career at Live Oak Bank, head of data analytics. He was the co-founder of Lumos Data and designed the Prime Plus model. And so he's working for us. And the reason that I had asked him on today, the Community Advantage program has now become permanent. It was started in 2011 as a pilot program. And back then we had CDCs and CDFIs that weren't 7A lenders into this space. And it was difficult back then because you didn't have some of the tools that we have today. And so the risk profile, we've seen defaults go as high as I think 7% at one time. But so what we have today, what I wanted to share with you is Stephen's going to go over the state of small business lending and kind of the analytics that you can use to help you make good credit decisions. Am I right, Stephen?
Yeah, thank you very much, Chuck.
Sure
I'm
thing.
excited to be here. So,
Thank you. Thank you.
well, let me share my screen, and thanks for that introduction, and I'll kind of go into it. Public speaking isn't my really day-to-day gig. I much rather deal with spreadsheets and models, but hopefully I won't bore you all to death and give you some cool little takeaways as you're thinking about risk.
And one thing I did want to mention, you're in charge of head of data and AI strategy, which is a hot topic nowadays.
Yes. All right.
Yeah, and so if there's any questions along the way, Steve, I'll butt in and let you know, and we'll make sure they're answering. So please utilize everybody that's on there. If you have a question has got to be one of the smartest people I've ever met, please drop in a question. We'll make sure we're discussing it and getting an answer for you.
Yeah, sounds great. All right, Chuck already gave an introduction of my background. I will say, one of the things that kind of led me on the path of Lumos and then my role here at Lenders Cooperative is in 2015 when I was at Live Oak Bank leading their data analytics group. We started an initiative to focus on small dollar SBA loans. And at the time, there weren't really, credit scores out there that really kind of catered to small dollar, small business lending. And the technology was really not there yet. And so we really struggled to originate small dollar loans in a scalable and in a way that addressed the higher credit risk inherent in small dollar, small business lending. But, excited to say that there's a lot of tools and the technology's come a long way that I think really gives lenders the ability to succeed in this area. So kind of to start off with, want to talk about the current state of small business lending and then really drill into kind of how we think about credit risk and developing out a risk profile specific to small dollar small business loans. So if I look at the SBA space over the past 20 or so years, for a long time, lenders were doing more and more large dollar loans. You can see that orange line going from 52% down to 16% of small dollar loans as an overall percentage of SBA. But really over the past 4 to 5 years, we've seen dramatic growth in the small dollar lending market within the SBA, growing from about $4 billion a year to $8 billion. Now, in talking to some lenders, changes around kind of the requirements, higher SBSS scores, et cetera, have kind of dampened that a little bit over the past 6 months or so. But really, over the past 5 years, we've seen a lot of growth in the small dollar lending space. However, with that growth has not necessarily come an increase in competition. If you look at the number of approvals by the top 10 lenders in the under $500,000 space, the top 10 lenders do over 50% of the volume in the under $500,000 loan market in the SBA. And you can see on the right-hand side, the number of lenders actually participating in that market has been decreasing steadily. And because it's become more concentrated, the actual competitiveness of the under $350,000, under $500,000 market has become less and less. So huge market growth, but actually a few lenders have figured this out, and there's more concentration in terms of lenders in the market. Pricing has been relatively stable. In general, under $500,000 loans average prime plus 275 pricing. as Chuck mentioned, I helped co-found a company called Lumos Data with really a mission around small dollar, small business lending. They came out with a report earlier this year that shows that defaults have reached their highest level at 3.69% over the past decade. So we've seen defaults increase in this space. They also put out an economic index. And what this index shows is what is the current economic environment. So think interest rates, labor markets, inflation, volatility of the market. What does that say about our predicted credit losses in the small dollar space over the next year? And the current index is at 125, which what that means is that we would expect over the next year losses in the small dollar space to be 25% higher than what we've seen over the past 30 years. And because the last 10 years had a very good credit cycle with lower than average losses, we would expect that losses over the next year, because of the current economic conditions, to be 64% higher than what we've seen over the past decade. PayNet is another company that puts out different small business indices. What they're showing currently is lending activity is down by about 5%. And they actually have a different prediction in terms of credit losses over the next year. They're actually seeing, while defaults are up by about 1 basis point, so basically nothing, they're expecting defaults to decrease by about 25 bips over the next year. So kind of two different stories coming from Lumos and from PayNet. So that's kind of a general overview of the small business market. So now I want to talk a little bit about the challenges in small dollar lending that I think makes it unique, but also opens up a world of opportunities for lenders who excel at it to really grow their market. So first, there's 33 million small businesses in the United States, and 96% of them have less than 10 employees. And those smaller businesses, the under 10 employees, typically are the ones that are going to be higher risk and less likely to be able to qualify for a loan. And so they're the most disadvantaged group. And there's a huge market of those small businesses. A lot of those small businesses have to go to hard money providers and pay excess interest rates in excess of 40%. But, SBA presents a unique opportunity to be able to offer loans to a lot of disadvantaged businesses that may not qualify otherwise. So, and kind of the reason we built the Lumos Prime Plus score when I was at Lumos, that is really to solve kind of two key challenges. These are two challenges that back in 2015, Live Oak wasn't necessarily able to figure out, and a lot of lenders weren't able to figure out. But because technology has come a long way, these are two challenges that are now at the fingertips of a lot of lending institutions to be able to overcome and succeed in small dollar lending. So the first major challenge that lenders face in lending to small dollar small business loans is that small loans historically have 2.5 times the credit risk of large dollar loans. And what's worse is in times of economic volatility, we see that kind of gap expand. So small dollar loans tend to be more prone to economic volatility and more sensitive to it than larger dollar loans, which kind of makes intuitive sense. So higher credit risk means you have to have, more risk mitigants to be able to make these loans. But that kind of flies in the face of the other major challenge that we see lenders face, and that's that you have to scale down your operations significantly. On average, we would expect you to have to scale down your operations by about 6x to make the same dollar or same percentage of profit, let alone the same dollar of profit, because you have to do more of these deals to make the same dollar of profit. And so these two challenges don't really work kind together, right? So you have to have a more underwriting, more due diligence to mitigate the higher credit risk, but that then kind of doesn't enable you to scale down your operational cost to make these loans profitably. And that's why we think that a score-based risk profile that's automated in a technology platform makes so much sense for these loans, because a score-based approach, if you choose the right score or scores, you can help automate and mitigate the credit risk while also helping you scale down the operational cost. Any kind of questions on that before I kind of go into, so that's kind
Actually,
of
I do have a question. Yeah, if we can. The score based is popular, and when when the small loan was 500,000, there were some lenders that were doing pure score and go, but many of the lenders want to have at least some kind of spread. Am I right, David?
Well, certainly. I mean, the idea of, well, I mean, so part of it is that, Stephen, I think you were saying, and maybe you're going to get into that a little bit more there, but right, many of them, SBA is the one that was offering up like the SBSS score as a primary factor in there, and they set a low threshold. And so I think, Chuck, what you were referencing to is the fact that many lenders are doing that as long as it met that minimum. You know, they were running with it, and that's not necessarily the end of the analysis, right? And I think you're probably going to get into that a little bit more, Stephen. And so we might can dive into more deep to that. But I certainly know there's some hesitancy from perceived gaps that simply using the score leaves you. You know, obviously, if you're looking into the 5 C's of credit, that score doesn't feel like it's addressing everything. So we can kind of talk about how that, and I want to clarify one more thing, that your 25% increase comment that you made on one of the other slides, I think that got missed by a couple of people, but it was a 25% higher. Yeah, that one. I'm sorry. Go back to your.
right.
Yeah, right there.
Yeah.
So that was just compared to 6 months ago.
No, so so this is an economic index that looks at what is a variety, I think like probably 15 different economic factors say about the predicted credit losses you can expect on your small dollar small business loan portfolio. And right now, the index being at 125 would indicate that it would expect, because of the economic environment that we're in today, that would suggest that credit losses for that type of loan would be 25% higher than the 30-year average and 64% higher than what we've seen over the past 10 years. The last 10 years saw losses that were, 25 to 30% lower than the long-term average. The current economic environment, at least historically, does not bode well for credit losses relative to what we've seen over the past 10 years.
Thank you, Steve, for clarifying that.
Thanks.
Any other questions?
Thank you.
Yeah. So let me talk about scoring and hopefully address some of the points David made and light spreading and stuff. So before I get into scoring, though, I want to talk about kind of high level factors that you can look at in addition to scores to help you weed out or address credit risk. So one of the first things that we do when developing out a risk profile is we look at what market the lenders are in. And that could be a geography, it could be certain loan types. A lot of times we see industry as a requirement. So whatever the market it is in, we use that to help us determine what risk profile we should look at. So one of the things we look at is industry. Industry is one of the most predictive factors in terms of credit risk. When we were at Live Oak, one of the ways that Live Oak grew is that we were able to identify good performing industries, and we built a business and market around it. Not every lender or bank it functions the same way, but industry is an important component, and it should be something that's included in your risk assessment. So risk of credit risk is an important component, but also lenders are more active in certain industries. So if you look at restaurants, there's a lot of activity in that market. Certain markets around industries are less competitive. And so if you're, even if you're not risk-based pricing, if you're setting, loans at a max price, that price may or may not be competitive depending on the industry that you're in. So industry is an important component from both a pricing approach, and from a credit risk approach. So one of the things that we do when we talk to, yep, go ahead.
That must have been an echo, Steve.
Yep,
go ahead.
All good. So one of the things that we will discuss with different lenders is are there certain industries that you don't want to lend to as part of developing out a risk profile? And so that includes looking at pricing, and it includes looking at credit risk, but there's other factors, reputational, AML risk, that may be that a lender may want to take into consideration. So we maintain a list at Lenders Cooperative of all the different NAICS codes and classify them into different risk categories and help banks think through and other lenders think through what industries they want to lend to. We also have a report. You can ask Chuck or I for it afterwards, that we're happy to provide, that looks at the performance of top industries across approvals, prepayments, defaults, losses that you're welcome to have. All right, so let's talk about scoring. So when lenders are looking at small dollar small business loans and looking for a score-based approach, the most common scores they're going to use for setting thresholds are FICO and SBSS. And so want to talk a little bit about those scores, but also want to talk about another score, the Lumos Prime Plus score, that we have a close partnership and is embedded in the Lenders Cooperative platform that we think also offers advantages to lending to small businesses. So first on FICO and SBSS, I want to make a couple of points here. So first, we did analysis at Lumos of tens of thousands of different loans with their SBSS and FICO scores. And what we found is that for small dollar small business loans, both of those scores can be very highly correlated with one another. So what we find is that for smaller dollar loans, we think that there's less business and trade history, or credit and trade history, that goes into the SBSS scores, because a lot of these loans are newer businesses, they are smaller businesses, they might not have a lot of that data. And so FICO and SBSS end up being highly correlated with one another, so that you don't actually get a lot of lift by using one over the other, because they don't have that extra data. What we also found, so point 2, is that SBSS doesn't really perform significantly better. It really doesn't perform better at all than FICO in terms of predicting defaults for small dollar small business loans. So if you're thinking about both of those scores, they're very correlated with one another. For small dollar small business lending, we didn't see a huge difference in terms of their predictive power for predicting defaults. So that's kind of point 2. Point 3 is that for severity of loss, we found almost no correlation between FICO and SBSS and the loss given defaults, the severity of the loss you can expect. So if you're thinking about, if the loan defaults, what would be my charge-off rate? Higher FICOs, higher SBSS, at least historically, don't tell you really anything about what kind of loss you would expect. You would just want to use probably some sort of average loss given default in lieu of those, and it would tell you just as much about the severity of the losses. The fourth point I would probably make around FICO and SBSS are that, and I see a lot of lenders want to do this, is stacking conservative thresholds across multiple scores, especially when those scores are correlated with one another, means that you're going to decline, so not approve, more loans, and you're not going to necessarily see an improvement in your credit losses, because you're stacking conservative thresholds of the same score. One score doesn't tell you much more than the other. And so you're not going to necessarily see a huge lift in your predictive power, but you are going to decline more deals if you set conservative thresholds across the thing.
Hey, Steven,
yep,
I think I'm following what you're saying there, but can you give me an example of what you're talking about?
Yeah, so one thing we often see is like we'll present, hey, here's the expected loss you can expect at different FICO thresholds or different SBSS. And so a lot of lenders want to set conservative thresholds across every score. And when you do that and essentially stack that conservatism across scores, we see banks that or lenders that do that end up declining a lot more deals than they would expect or want to. And so generally what we recommend is pick a score that you want to be kind of your predictive score. You can set the conservative threshold there and have looser thresholds with other scores, or potentially have kind of like looser across multiple different scores. And you can achieve the same credit outcomes by having a looser threshold across multiple predictive scores than by setting one conservative threshold in one score. Does that make sense?
Yeah, I think it is. So in other words, if you're setting a minimum, say on your SPSS, and maybe that's 165, since that's where SBA has set that, right? But if you're then setting a FICO threshold, what you're saying is you'll have something that would score and meet the SPSS threshold, but because FICO is slightly below that, that doesn't necessarily mean that's giving you a better credit outcome. You could just be declining a deal you would have otherwise been happy to do.
Yeah, and so that's a great example, because you got a 165 SPSS threshold. I wouldn't then tack on a conservative FICO or a conservative Lumos on top of that. I would have a looser of both of those thresholds, especially thinking FICO, because FICO and SPSS are very correlated with one another. I wouldn't have a conservative FICO. I would say, hey, you're at 165. Let's have a looser FICO threshold, just to kind of cover our bases, but not setting a super conservative FICO score.
So you would be able to do something, say, like what does that generally correlate to? And I understand they're not the same, but a 165 is roughly the equivalent of like what, 730 or something?
Let's see, I've
Would that
got
be right?
that. I think I've got that here.
Oh, you've got that further. So in other words, if that were the case, you would set a lower FICO there, knowing
Yeah, so
that
I mean, a 165 SPSS is going to come out to somewhere between probably around a 700 or so, a little bit better FICO.
Okay.
Yep.
Chuck,
I
you
will
got
say
anything
that
there? You good?
I will say the other thing that was kind of interesting in our analysis is, and this actually does relate to how lenders think about setting thresholds, is that for FICO specifically, you've got multiple guarantors sometimes on these loans, and they're each giving you their FICO, and so kind of around determining which one do you use. So we see some lenders might take the average, some might take the minimum. We did an analysis historically of looking at the minimum, the average, and the maximum of the guarantor's FICO. And what we found is that the most predictive is that if you take the maximum FICO, that's the most predictive in terms of predicting default rates. So if you're thinking of choosing one that's most predictive, the maximum is not. So a lot of lenders will maybe say, hey, we're going to take the minimum across those because that's the most conservative, which is true in the sense that it's going to be less. But just to give an example, a 700, maximum FICO versus 720, where you're using the minimum FICO, might correlate to the same credit loss, but the maximum FICO is generally going to be a lot more predictive. So just a example of how that decision could potentially matter. Any other questions on FICO and SPSS?
That's an interesting statistic there you're bringing up, and I mean the analytical part of me wants to dig into that, but I know we don't have too much time here. But that takeaway there, I mean, so if your minimum score, you might have something like a 680, but that's coupled with a 770 right together, versus this other one over here that's just one owner that might have a 720. What you're saying is that even though this other score is lower, because the two together, the higher indicator would be the better score between the two. Is that, I mean, I butchered the way I said that, but
yeah, essentially the guarantor with the best credit is a better predictor of your default than the worst credit of the guarantor. The guarantor with the worst credit.
Okay.
Now, all of them are predictive, and I wouldn't necessarily changing something, but that was just an interesting tidbit as part of the analysis we did. All right. So now I want to talk about the Lumos score. So this is a third option, and we regularly use this score. It's embedded in our platform. A lot of the lenders that we work with use it for determining, either having a decision threshold, or sometimes also using it for determining pricing of the loans. And so the Lumos score is we've got a database of over 2 million historical SBA loans. It's built on 3 decades of data, and macroeconomic data is a key component of the model, and it covers 3 kind of different economic recession periods: dot-com crash, Great Recession, and COVID. And there is loss data in that data set across all types of businesses, industries, franchises, and geographies. And so it is a great tool to be able to build off a model for predicting small dollar small business defaults. And so that's what we did. We built the Prime Plus credit score. It takes into account both a probability of default, and the other kind of novel thing is it actually predicts the loss given default. So I mentioned SBSS and FICO tell you really nothing about the severity of the loss. We built out a model that actually will predict the loss given default in addition to the probability of default. And so combined, what Prime Plus does is it predicts the expected credit losses for the next 12 months for small business term loans and lines of credit under $500,000. It's built off of SBA data. It's been tested on non-SBA data, but its kind of bread and butter is small dollar SBA loans. And it's one that we think is more accurate and fairer than both SBSS and FICO scores. So whether you use a score or something else, I'll tell you the top 10 or top factors that influence both the PD, the probability of default, and loss given default. So whether you're using a score or whether you want to embed this in your underwriting in some way, these are kind of key factors to look for that tell you about the risk of small dollar small business loans. So one is the local employment environment. So think the county unemployment rate, labor force, et cetera, is one of the most predictive factors of a small dollar loan's performance. The second one is one we already mentioned, is the industry the business was in. Short and long-term interest rate environment is the third most important factor. Owners' FICO scores was our fourth most important factor. So FICO scores are an important component of the Prime Plus score. So you can think of the Prime Plus score as having the FICO in it, plus a lot of other factors on top of that to build a more predictive score. One thing is you can see on the left, that left-hand bar is the probability of default, and the right hand is the loss given default. The credit scores, that yellow section, tells you a lot more about the probability of default than it does about the loss given default. But on the right-hand side, the severity of the loss is much more sensitive to the economic environment. So if you think about, hey, going into a time of economic uncertainty, what's going to end up happening is you probably will see the amount of losses you take for your defaulting loans accelerate a lot more than you might see your probability default, because the loss given default is a lot more sensitive to the economic conditions than the probability default. Both are sensitive, but loss given default is more influenced by the economic environment. Any questions on that?
I think that makes sense.
Yeah, so I mean, real world example of what that looks like is, so left-hand side here, we have a Subway and a Jersey Mike's. A lot, both are in the restaurant industry. And so we see a lot of lenders who, hey, restaurants are too risky, we're not going to lend to them, or maybe they do lend to them. FICO scores here are 750. A lot of lenders we talk to will set a FICO threshold. So these might both, pass that. But what we find is, despite the fact that they have a FICO score that's the same, and both are in the restaurant industries, is very different expected losses. Subway historically performs worse than Jersey Mike's. The one on the left is in a worse economic environment than the Jersey Mike's. And the one on the left is a startup, smaller business than the more established Jersey Mike's. And so all of those different factors can contribute to very different expected loss outcomes. So while it may be tempting to just, hey, we're not going to lend to certain industries because it's higher credit risk, there's a lot more that go into it. And so in the restaurant space, based off of different factors, you can actually find really good performing loans, despite the fact that that industry tends to have a little bit higher credit losses than other industries. So just to end on accuracy and fairness, like I mentioned at the beginning, is we did a blind sample test comparing the Prime Plus model to both FICO and SPSS. And what we found is that we were able to identify more defaulting loans by about 40%. We were able to approve 20% more good loans. And because we're approving more good performing loans and we're declining more bad defaulting loans, you're able to boost profitability by about 80%. So that's where using a good credit score can make a huge difference on the actual performance of a small business portfolio. We also compared the fairness of models. So we looked at the Prime Plus score against the FICO scores across the owner's gender, race, ethnicity, and nationality. So obviously using things like county unemployment rate, we were wanting to look at, make sure that, hey, we weren't building a more accurate model, but at the expense of a less fair model. And so we evaluated using a metric called proportional parity across all these different factors. And not only did we exceed the thresholds for that, across gender, race, and the county, we were able to both be more accurate, more fair in terms of approvals, but also more fair in terms of pricing if you use the Prime Plus for pricing than something like FICO. And so what that means in practice is not only will FICO approve more defaulting deals and decline more good deals, the outcomes of the loans that approve will be less fair than if using a score like Prime Plus. Any questions on that?
So that's interesting and help me here. So the like when you're talking about the county of business, that's not something that comes into play with the consumer credit score, which is interesting given that what you're describing is using the location resulted in more fairness.
Yeah,
because of all things
yeah, how to interpret that is there's more disparity from location to location in FICO scores. So certain counties might have really low FICO scores or versus other counties. Versus the disparity in credit risk. So you'll see more disparity in credit risk from county to county than actually you'll see in the loss rates. And so because FICO is not a perfect predictor of credit risk and there's other things that go into it, that's just something to keep in mind, is that by setting just a FICO threshold, you might be, acting unfairly potentially to certain counties or to certain types of businesses by using a score like that, because it can have, adverse outcomes or unintended consequences. Any questions on that?
No, not about that. No, thank you.
Yeah. So then, how do we take this information? So we look at, the market the lenders are operating in. We have access to these scores. How do we actually then start building a risk and pricing profile? And so, this is unique for every lender. Some lenders like to do risk-based pricing. Others don't. They operate in different markets. They have different different approaches to credit. So it's not really a one size fits all, but I'll tell you how we approach it and how we kind of start to put some of those different data elements together. So first, and this is maybe something you can opine on, David. One way we think about it is a lot of lenders kind of approach small dollar lending and large dollar lending very similarly. They might even use the same credit memo, a lot of the same processes. And as I mentioned earlier, you have to be able to scale down your operational costs to be able to make a financially viable business out of the small dollar lending. If you approach it the same way as a large loan, you might not be able to achieve that. And so generally what we recommend is a score and light spreading approach, where you have an abbreviated spread to still account for some of those other C's that David was mentioning, plus a score-based approach. And then depending on the loan or the circumstance, or if they get comfortable with the score-based approach, for certain loans that meet certain or higher or meet stricter thresholds, a score and go approach. And so a lot of times we'll recommend kind of multiple tiers where there's a score with a light spread, and then for maybe certain types of loans, score and go approach. Anything you'd want to opine there, David?
Well, I mean, I think it's imperative that I mean, you all have to be sort of one mind. I mean, that's the sort of thing you're introducing. You make sure your credit leadership is on board with approaching it, whatever you end up doing. If the goal is to discuss that, sorry, the 96% of businesses out there, right? If their need is well under that $500,000 mark, I know the nature of trying to meet goals and do all the things that are associated with lending. If all of the steps mean that it takes you as long to do that $200,000 loan as it does to do that $750,000 or $1 million loan, it's just a human nature. You're going to focus on the things that you can get done that kind of help you meet your goals and the department and so on. So like it's really important that you're not setting yourself up for a scenario that I'm going to do all these extra steps, but if I'm looking at it, am I actually getting the benefit? Like, does it give me 4 times the predictive value? Doing these extra things that take 4 times as long is this sort of the way I look at it. And you spoke to the efficiency ratio and whatnot that you had to consider there. And so, and there's always the other argument, and I've heard this too, that if you're doing the spreading, are you getting the same value out of it? The customer that brings you a tax return for their business because they're needing, 150,000, whatever is the loan, versus the customer that needs the $1 million. I don't know that those tax returns are of similar quality, or at least from their ability to be able to spread them. There might be something where there's a lot more mixture of personal and business finance activity going on, in the smaller business, because for some reason they don't want to pay extra taxes if they don't have to. So a lot of times I see that those seem a lot tighter than in reality, versus the larger business has already understood what you have to do to become bankable. And so I think that's where predictive data becomes far more helpful, because you have the ability because it's essentially, it's not impacted by whether or not, do I consider this vehicle a company asset or a personal asset? That something as simple as that impacts that outcome on your tax return.
Well, I'll kind of end on how we put it all together. So we'll produce this kind of matrix of the expected loss. And so some lenders might want to set cutoffs for FICO and and they'll set thresholds for FICO and SPSS. They may also set one for LUMOS. And then what we'll do is we'll set essentially at different expected loss. So this is an annual expected loss threshold, and this can be LUMOS, but we also have those for FICO and SPSS equivalent. We'll set a maximum loan amount that will be based off of usually 33%, although this is configurable, of the gross revenue, or the expected loss threshold. So we'll basically take whichever one is the lowest between the credit risk based off of expected loss or 33% of the revenue, and we'll set these max loan amount thresholds. And so here you can see as the risk goes up, the maximum allowed loan amount goes down. And then we also will generally recommend a risk-based approach to where your pricing is lowest at the lowest credit risk and highest at the higher credit risk. Although some lenders will just want to have a set flat price, and that's perfectly okay too. And we'll just set that across the board and just make sure that it's competitive in the markets that they're operating in. We base these pricing, so things that go into pricing in this RAROC approach is we'll look at the size of the loans they're going to do, the credit risk, cost of their financing or deposits or other debt, leverage ratios, capital ratios they're comfortable with, operating costs, all to determine the pricing that will meet their return on capital thresholds, but also be competitive in the market. Any questions, Chuck? I think that was all I was going to go over.
That's good, Stephen. This has been helpful because we're working with a number of community advantage lenders, and utilizing these tools is going to be helpful in having them make their decisions. The other point you had mentioned a couple of times that this is embedded in our platform. We have a number of ventures users, and with that acquisition, That's going to be available at some point in 2025. So it's a tool that I'm excited about, and it's really going to change things, I think, for small balance lending. I would like to just say that this has been a great. We're going to send this out to everyone. Next month, in August 21st, on Thursday, we're going to have a guest, Dustin Baker. The barriers to entry in SBA lending can be staff acquisition, staffing cost are 40% more than what they were 4 or 5 years ago, and then training and development. And he has developed an innovative training tool called Chatterbox. And I thought that would be a good topic for next month. So we want to thank everyone. And again, as David said earlier, we're going to send this PowerPoint out to all the attendees. If you have any specific questions on this data or you want to use this data, please reach out to any one of the three of us. Steve and David, thank you so much.
Thank you all.
Yeah, thank you, Chuck.